The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. If you have any questions, it's 877-927-6648. We're going to start the show by, I put the weekly hog chart into the TFNN Tiger TV this morning because there's some news on hogs that was in the stock market yesterday. China, one of their companies in China, has decided to buy Smithfield Foods. Smithfield Foods is the largest producers of hog products in the world, and they have it's a quite a large corporation. $4.5 billion, I think, was the price. But what's interesting about this, I've just put the chart of hogs. I don't trade hogs very often, maybe once or twice a year, because cattle trade much easier and they're far more liquid. But the hogs trade very nicely with the patterns, by the way. It's just that they're a lot less liquid than the cattle. But the thing that's important here is that on the CNBC yesterday, after the announcement came after the close, the Smithfield stock rallied 30%, and they had a couple of analysts on there, and they were giving their ideas about the two things that were happening in the hog market and stuff. And the reason why I bring this up is that you got to be really careful of what you hear on the news, and that's including me too. So, but the main thing is that they were talking about, they were going to take all the little piggies from the United States and move them to China. I mean, that's the most ridiculous thing in the world. The reason why the Chinese company bought this Smithfield Corporation is because of their production standards. They have the greatest production standards in the world because hogs are very susceptible to disease. People always think of hogs as being very dirty and, yucky, but in fact they're really not. They're actually quite clean, compared to the other animals like chickens and cattle and stuff like that. Now, the reason why the Chinese company bought it, and then later on that evening there was another analyst that came on from the CME, a hog trader that knew what the actual answer was, and that was they bought it because of the production standards that were there. They basically, if you have a USDA, U.S. Department of Agriculture stamp on something that is made in the United States, sold in China, it has basically the Good Housekeeping seal of approval. That's what they were buying. And they are going to export the production capabilities, not the hogs themselves, but the production capabilities to China. They're going to buy those patents and do that. Frankly, they must have had a pretty good reason for doing this because, you would think because of espionage and stuff like that, they would have tried to find a way to do it. But it's very scientific the way that they have the meat prepared because most of the hog products, are sold as, frozen products. Just a little bit of it is sold as fresh hog. Most of it is in bacon and hams and things like that that are canned. So that's the reason behind that. So the two things is the fact that the hogs trade quite nicely, and the second reason is that they you have to be really careful about listening to anything that happens in the markets when someone says something. So you have to prove it to yourself. It goes back to Jim Twentyman's favorite saying, defy human nature, do the work yourself. Now, the next chart that I wanted to bring up to you is in the news also, and that is, we had housing starts are going crazy. I saw on both CNBC and CNBC and also Bloomberg this morning that the housing the housing crisis is over and prices are going back to the highs of 2006, and they certainly might be. That's always a possibility. But what I wanted to do was to show the price of lumber, which has a correlation of about 85% to the stock market, and you'll notice that the price of lumber over the last 6 weeks has dropped 32%, whereas we've gone higher in the stock market. The lumber market has turned down a considerable amount. In fact, it's dropped the exact same amount that it dropped in 2010. So it's had a very, very huge, correction. Now, whether that means anything or not, I don't know. But they do use lumber. At least I still think they do in housing. So we'll have to, see what will happen when and if the stock market does turn down. I'm not going to spend a lot of time with the stock market today because we're talking about the futures markets, and that's the one that I think really we really need to focus on. Now, I'm going to the next one. I want to start out with corn because during the time while I was absent, we had a perfect signal occur. I know that some people in the Tiger's Den were able to take advantage of it because Mr. Z was in there, touting the buying of corn, way back a couple of weeks ago when the price of corn was coming down. This was what we've been waiting for all season long. That is the fact that we've had this ABCD pattern completing during the May-June area. That's pretty much what has happened. We stopped exactly at the D point down at $5.10 a bushel in December corn, and we've rallied well over $3,000 in a matter of 9 days. So this has been a pretty big rally that has happened. So that's something that I think will be be very interesting to see if we get a pullback here, which we usually will, because we're going to get a lot of different things with the weather related to corn, but we want to be watching the corn. If we get about a 20-cent correction in corn, we certainly want to be looking to buy December corn because we have the same potential for corn to rally this year like we had last year. Now, last year was a drought-related year, so you don't always actually get the, you don't always get the same move year after year, but they can be quite similar and still be quite a little bit. I am going to cover the U.S. dollar index. Someone asked a question about that. We talked about that on yesterday's show about the dollar index, and that's what was leading to the euro and the pound and the others rallying pretty good. We'll go into that a little bit later. I want to cover the grains first because that's the strong part of of the commodity markets are your soybeans, wheat, and corn, and those are the ones that I think that we need to cover the most. Okay, I was almost tempted to do the U.S. dollar index because it was first up on my list to do it. In fact, I think I will because that will keep me from making a mistake and pulling up the wrong commodity. But I'll pull in that dollar index that you'll be able to see the double top that occurred last week. As a matter of fact, it happened several times up at this 84.50 level. That was equivalent to the euro going down a little bit below the 128 level, which was the 786 on the daily on the euro, and that's why the dollar index is held there. Now we've been down 3 or 4 days now in the dollar index, and today's the first really big strong day that we've had. We've had the euro move quite a bit. It moved a little bit yesterday, moved quite a bit today. So that's what we'll be watching. The next one that I wanted to go into would be the soybeans. I'll get back to the markets that I hopefully cover during the first section of this, so we can move on to the things that. The first one I'm going to show is I showed December corn, which is the new crop corn, and now I'm going to show new crop soybeans. That's the November soybeans. July soybeans, which are the beans that are already in the bin, and they're selling them now and using them now for soybean oil and soybean meal and all the other products that come from soybeans. But we've had a tremendous move in the soybean market, just like we did in corn. Part of that is related to the wet weather that we had across the Midwest over these past few weeks. But the main thing that I think that is very important here is that we've had a huge move in soybeans 3 days ago where they went up just about the tradable limits for November beans, and it stopped exactly at the 61% retracement, right around this $13 per bushel level. And if we can get the soybeans above $13 a bushel level, I think we're going to go a lot higher. I don't think there's any question that they're not going to be going higher. The question is, are they going to back off a little bit in order to, before they have the move up? Someone posed the question, well, if I think they're going to be going higher, why don't I just buy them now? Well, the reason is how much do you risk? I mean, I have to put a dollar amount. I would have to risk somewhere between $750 and $1,000 per contract, and I'm not willing to risk that, especially when I don't have a pattern, confirming it. But just looking at the pattern that I'm watching now, that I posted into Tiger TV, this market wants to go higher. I mean, it's had higher bottoms in December, it had higher bottoms in May, and it had higher bottoms in April, and it had higher bottoms in May. I mean, it's been screaming that it wants to be bought, all along. We've been bullish this for quite some time, waiting for this time in May, to look to be the corn buyer. Of course, corn was what we were looking for, and it went to the price. But the soybeans exploded out here and went a much, much higher than the corn did. I mean, they're more valuable than the corn because they're trading at around $13 a bushel, and corn is trading at around almost $5.50 a bushel. Remember, you get 3 or 4 times as much corn per acre than you do with soybeans. That's what makes up the difference. So that's how they figure out the crop sizes and what they're going to plant and stuff like that. But this is just the end of May, and most of the corn is in now. There's some of it still not in, but most of it is in. And now the growing will start, and we'll be watching the weather reports for reports of high weather high weather areas coming in to the United States, because when you see a high weather level come into the United States and it sets above the Midwest for more than a week, it brings in drought-like conditions, and that's what causes the grains to go crazy, the lack of the water. And that's what caused the move last year that took corn, up well over $10,000 a contract, and soybeans up over $20,000 a contract. And, of course, after the rain came, it could be going down, to the downside. Someone asked a very interesting question. Since we have this soybean chart up, they asked the question is, could that be a 135 pattern, which is a bearish pattern in the soybeans? And it certainly could. And the reason why is they both stopped exactly. Number 3 stopped exactly at the 61% retracement, and number 5, the one that we're in right now, stopped exactly at the 61% retracement. So this is another reason why I can't be buying it here, but I would like to buy it on a pullback. So, but that certainly could be a 135 pattern. Remember, we have a bearish scenario as far as the long-term trends in soybeans and corn, that they've been in downtrends, since last September, and these are the strongest rallies that we've had, since that time. And markets always do rally, no matter whether it's you're bullish or bearish, they do rally, and then they start back down, the next leg down. So we're ready to see the next pullback in both corn and soybeans, if in fact this is the case. Now we got to take a little break here. And when we get back, I want to cover the wheat market, and then we'll talk a little bit more about the dollar index.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Okay, folks, the next chart that I posted into Tiger TV is the wheat chart. That's the third one of the corn, wheat, and soybeans group that we like to follow. And you'll notice that wheat has rallied virtually nothing at all. It's made a small Gartley about a week ago and has not really moved very much from that point. That doesn't mean that it can't, but it's a perfect example of you must trade what you see and not what you think, because, you know, if you would have bought wheat thinking that it was going to be tagged along with corn and soybeans, you would have been, wrong, because, soybeans and corn went straight up and wheat went nowhere. So let the chart do your talking for you. So it's still holding support here at this $6.80 a bushel, but it still is not ready to really go any farther to the upside. I want to cover a little bit more about the dollar index, and when we come to the break, I need to get into the gold, and that's what I really think. There's a real possibility in gold here. It's going to be interesting on this next move that we're having, how it's going to, come together, but we'll have to, watch it, most closely. I'm trying to search now to get, there's the euro that I wanted to bring up here, and just to show you where we are with the euro based on last few days' action in the euro, because this is just a short covering rally in the euro, which is equivalent to that double top that we're looking at in the. Now, I'll see if I can get. See, I can't get this chart to post in the room unless I turn it off and turn it on, but that's what I'm going to have to do. Okay, this chart that I posted is the euro over the last month, from the month May 1st to where we are now. We've gone from 132 down to 127, and over the last 10 days, we've had a nice rally that's taken us up to the 61% retracement, which is up near this 130.50 area. And that's pretty much about the extent of the rally. that we should get. That means that the U.S. dollar index should pull down to a 38% retracement, which would take it just below 83, I believe, 82.70, somewhere in that ballpark, and then we will look to see, to go long the dollar. But, if the euro does change its mind here and, take off above 130, 150 to 132, then it's made a major bottom, and it could go a long way. But right now, all we're doing is we're having a snapback rally, much like what I think we're seeing in the stock market, in the S&P and the Dow Jones, is just markets that have been oversold for the week and are coming back to to make a short-term correction and then head more to the downside. So that's what we're looking at with the euro. The pound looks pretty much the same. It was able to hold the 786 level down at the 150.70 and has been able to rally a little over 140 pips. So that's the main thing. Now, there is another one that I think is very, very important here, and that is the Japanese yen, because we've been watching the yen for a very, very long time. And there it is right here. I want to show you the relationship between the yen, since we're talking about currencies here, is the relationship between the Dow, the Nikkei Dow, and the currencies, because they're very, very correlated together, nearly a 90% correlation. And we made a 786 retracement this week. Late last week in the Nikkei Dow. It came in exactly at the 786 retracement. Well, when that occurs, the thing to do, because the Nikkei is hard to trade, because Nikkei futures are relatively thin, is to look at the yen-dollar Forex pair, because you can trade that one. You can short the yen, against the dollar, or buy the yen against the dollar, either way that you like, and that will give you a chance to enter it. And that's what's happened. We've gone from 103 down to par in the Japanese yen. Now, the Japanese stock market dropped almost 6% yesterday, folks. That's equivalent to 1,000 Dow points. Now, that could be a game changer. I don't know why it occurred, but it stopped exactly at the 786 on the weekly chart. It also stopped at that level we looked at 15,000 and change. In the Nikkei Dow was also a 382 retracement, coming off of one that was back in the 1990s. So this is still a long-term bear market in Japan, and we will certainly look at it. The problem with Japan is their debt is worse than ours, and they're still giving interest rates away at cheap prices. The problem is, the reason why they're doing that is they know that debt's not going to be repaid, so you can do anything you want with it. So who knows? We'll have to wait and see. The question of whether these announcements have effect, of course the announcement have effect, but we'll have to let the market determine what's going on. We've got to take a little break here, and we'll get back to gold and silver and copper. 877-927-6648.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and I posted into Tiger TV the gold buck index that we talked about yesterday. This chart is really important for a couple of different reasons. One is we've held that 786 level on the gold. That could be a really important spot, but remember that if it breaks below there now and we make new lows below last week, then this market is going to be incredibly bearish. The second thing about this pattern that is posted here for the gold bug index, that it shows that 135 reverse point wave, 1, 2, 3, 4, 5 reverse point wave pattern on the weekly chart of the gold bug index when we were in September, when gold was making the $1,932 per ounce level. You know, we've come down and been down very, very strongly for 9 months now, and so that tells us that this has been a pretty major correction. However, in a long-term scheme of things, if you're looking at this on a weekly basis like this chart is, it's still basically bullish because we've had higher bottoms in 2009, in 2005, and 2003. So we still have a potential, for gold to have a pretty good move to the upside. So that's the main thing that we're watching with the gold index. The next one we want to watch is the gold silver index itself, and that also has had some really nice patterns that have been going on for quite some time, and we've had some just about perfect Fibonacci retracement levels come in at the 50% and 60%, and now at the 7, 8, 6%. The key here is that this really has to get going. It's having a good day today and yesterday, last week, and also this week it started to move higher. And we're going to cover gold and silver when we're finished with this index. But it's a big index because it has all the gold and silver stocks, and those have really been beaten up badly. I mean, they've really gotten hit, quite a bit. So this is the moment of truth, as we say in the gold market. I listened to Basil's show, and he has a long-term bearishness on gold, and that could be the right thing to do because it certainly has broken a lot of major support, and gold will be testing its next level of support within about $20 to $25 from where we are right now. We're at 14.12. When we were on the show last week, I said we needed to get above 1400. And, we've certainly done that. So the next level is around that 1429, 1425 to that 1440 level in gold, which will be the next spot to see where the corrections. But the corrections have been holding well. They've all been pulling down, and the bottoms have been higher, which is good, and on your hourly charts and things like that. So all of it's telling us that, we're still in the midst of the rally in gold, and it still could have a pretty good move to the upside. Someone asked the question: are we going to have a bull market in gold and a bear market in stocks? They're two different markets, folks. They're like tapioca and bread pudding. They're not even related. So you've got to be able to see if that's going to be the case. We want to the key price here. In fact, I should put get the gold price up here right now so that we can just take a look at where we are, and then we'll move in to copper on a little bit longer term basis here on gold to look at it on the weekly. Then we'll look at copper, and then we'll take a look at it. The reason why we still have a chance for gold to be bullish, there are several reasons here. This is the long-term weekly chart going back 4 years. We made the 50% retracement off of the bottom in 2008. And we also made the 61% retracement off the bottom in 2010. Both of those were major corrections, but nothing like the one that we're having now, because this was the first major ABCD correction on the weekly chart that we had in a very, very long time, and we are coming out of it, pretty real, very, very strong, in my opinion. And the fact that we held that 13.22 level per ounce that we made back on April the 15th tells us that this is the possibility for the market to get going from in here. So I've been trying to position myself on the long side, watching for the dips to come in, which we always get them in gold, and you get a pretty good chance of picking them up on retracements, and that's what we try to do, is to buy on retracements here so you don't have to risk very much. Buying on strength has never been something that worked very well for me, either on the short run or the long-term basis. But this long-term chart on gold still has some bullishness left in it, in my opinion. However, if we take out those lows that we made just a week or so ago at that 13.45 level, 13.35 level, that to me would say that the bull market in gold from 2003, when it was under $300, to 1962 is over, and we could easily take back 61% of that, which would take gold under $1,000 an ounce without any trouble at all. So this is why we're keeping a close eye on this one, because the support is in. If it doesn't hold, then that's it. It's got some really negative things that are going against it, and that's something that you just don't like to do. We want to take a look now at the silver market, and because it is also been holding up together. Let's see if I can get this to come in. I don't know if the silver market has posted yet or not. I'll double check and see if it has. The euro. Yeah, they asked me what the targets are in the euro and the pound. The main thing is that we're just having corrections now in the euro. There should be some resistance at this 130.50 to 131 level in the in the market. So we'll notice to see if that's what's going to happen. In the pound, there should be some correction in around that 152.50 level to 153, and that's just making a another correction. Now, if this double top in the U.S. dollar at the 84.40 level that we were watching is a valid double top, this is a major double top, then you got you're looking at these currencies are going to go a lot higher than those little figures that I gave you there. So if we clear above 131.50 in the euro, and if we clear above 131, that would tell me we're going to go a lot higher. So that's the main thing. I'm watching the Japanese yen more closely than anything else because it's tied so closely to the Nikkei Dow futures. And when the market backs off almost 6% in one day like we did in the Nikkei Dow, that is something that's an outlier event, folks. So you have to pay attention to that. And especially since it came off the 786 retracement at around 15,000 in the Nikkei, that's very, very important. When I look at those numbers, I can remember looking at the Nikkei when it was trading at 39,000, almost at 40,000 back in December of 1989, and that was just really an amazing time because they put CNBC had a special, and they put $1,000 bill on the sidewalk in front of the Imperial Palace. A $1,000 bill is about 2.5 inches high and about 3.5 inches long, and that's how much you could buy for $1,000. As a matter of fact, the estimate was that the Imperial Palace area around Tokyo was worth more than the state of California. Now, that's really saying something. I remember that, but that's what they said. I don't necessarily believe it, but that's what they did say. But, of course, the market went from 39,000 all the way down to below 7,000 in 2003, where it stayed there for a few weeks, and then had a start of a pretty big rally. This is the largest rally as we've had in quite some time in the Nikkei market. Now they're doing the same thing there that Bernanke is here. He's started a school of printing money using his quantitative easing programs, and it's spread to Europe. It's also spread now to Japan. The question that I have is, if this is such a great deal, why hasn't the Federal Reserve been doing this more on a basis since 1913, when the Fed came into being again after being out of business for 50 years? I don't know what the answer to that is, but it's going to be see how they work themselves, out of the situation, because we are in an area where we're looking at higher interest rates down the road. I don't think there's any question that we've not made a major top in the bond market. I don't see how that is going to change anything at all. I'm going to see if I can get here it is right here, and we can hopefully I can see if it will post into the chart room now, and we'll see if you can see the bond chart going back the last 32 years, because we've had a beautiful symmetrical move that was very orderly all the way up, and we had the big major butterfly pattern form. And then we've also had the head and shoulders pattern form recently over the past weeks, and that's telling us that we're looking at higher interest rates and not lower interest rates. So that's it. They're making a little joke about my little bet with Tom O'Brien was that I didn't think bonds would see 160, and well, I don't really, well, they're 20 points away now. So if bonds to get to 160 from here, we'll have to be at an area where we will be at a, some type of flight to quality like no one has ever seen before, which we certainly could see that. But, right now it doesn't look that way by any stretch of the imagination, at least in my opinion, that we're watching. So the interest rates are going to be going higher. Now remember, folks, I'm a technician. I don't look at the fundamentals very much, and I certainly don't understand them. But I do understand the price charts, and the price charts have been something that I've looked at for the last 50 years, and these charts work no matter what you're looking at, whether you're looking at frozen potatoes or whether you're looking at live cattle, live hogs, the euro or the pound or whatever you're looking at. These charts work because it's the sum total of all the buyers and sellers, and it's based on a price chart that has a price axis and a time axis, and that's what we're That's what we're watching to do that. Someone asked a question about focusing on ETFs to buy the gold. I do not like ETFs. I don't care what where they're traded. I don't particularly care for them. Now, the ones that seem to work the best are the diamonds and the spiders because they follow the market, pretty good. Because you have these other other ETFs like TBT and DAS and SDS and some of these, not DAS, SDS, but they don't do the things that that they say they're going to do, in their brochure. So I in the write-up, of course, but I just don't believe them when I watch it. So I trade the net futures, and if you're going to do an ETF, the thing that I would suggest you do is really research the ETFs to your best of your ability, and Google, the thing, and you'll see some of these blogs that come up that people have spent some time with ETFs that have had some bad experiences. So you have to be able to understand, why the ETF is written the way that it is. Believe me, these people that put these ETFs out here, they're not doing them for your favoritism, folks. They're doing it because they're making money off of it. So you try to think of the other side of the trade, to see where the other side is going to be at that point. So I think that's important to realize that. Now we need to take a look at the copper market because we've had a pretty good rally here in copper recently, and we want to show you this rally because we went down within a few pennies of the exact low that we were looking for in the copper. We were looking for a double bottom for copper to form, and it did come in down at around $3.05 per barrel, $3.05 per pound level, and now we've had a 382 retracement of copper over the past 3 weeks, and the market hasn't really shot up to the upside, but at least it's got its oversold position into the market. But we've had such a tremendous divergence in copper for the last 18 months. I mean, with the stock market going straight up and copper going straight down, making lower lows and lower highs along the way, that is, to me, probably one of the most amazing divergences that I've seen, in the stock market during this time. It's just really amazing how stocks could go up and how the market in copper could go down. And we're seeing the same thing in lumber now. Lumber had a big divergence. That's what I started the show on, and it gave an idea of, the price of lumber has dropped 32% in 6 weeks. That's a big drop, folks. I mean, that takes a lot of selling for lumber to drop that much. That means there's not much buying, because if it was really wanted, wouldn't you think there would be some support all the way down? I mean, maybe it would drop 5% and then rally a little bit, but to drop 32% in a matter of 5 or 6 weeks is just really very, very amazing. Someone asked a question about the real estate market, and I know probably less about this market than any market. All I know is that when they tell you that the market is over, in other words, that the bear market in housing is over and the houses are going to go back to where they were in 2006, look around you, see what's happening in your area, because your area might be doing that. Who knows? We got to take a little break here, and then we'll finish up the show. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and I posted the chart for crude oil, and the thing that I wanted to mention here is the fact that we've had these lower tops in crude oil for quite some time. And we've backed off from that 786 level at 97 that we focused on last week. We came down about $6 a barrel. Now, what's happening in the crude oil market on a futures basis is that they're having a situation where the backward spreads. In other words, the market for next year is gaining a lot on the nearby, which means that there's plenty of oil out there, and someone is hedging their bets into next year. So this is why you want to keep an eye on crude oil, because if we get much below $90 a barrel, that's going to set up a move to potentially under $80 a barrel, because it'll break some major resistance. And we've had lower tops in crude oil for the past year or so, much like we've had in copper. Crude oil's acted a lot better than copper for probably different reasons, whether they're related to tensions in the Middle East or not. I'm not sure, but it tells you that, basically looking at, lower prices, because we've had these lower tops. We've had some higher bottoms, but the lower tops are certainly more pronounced. And it's interesting. I posted into Tiger TV today the Bradley stock market model, and it shows the model topping, somewhere in this ballpark right here. Could be off by a week or two. But the main thing that goes along with this is the fact that we've had these long-term patterns on the weeklies and monthly basis of all the stock markets in the world across Europe and across the United States and all of ours. It's really tells us where we are as far as looking at the Bradley model. Remember, the Bradley model, when it works very well. And when it doesn't work, you really can't use it, so you have to use the patterns first, and that's what I try to do. I use the patterns first, and believe me, I in all my years of experience, I've not seen it any more bearish in stocks than I see it right now. That's all I can say. I don't know, where the top is coming, but all I know is it's going to be quite interesting when it happens, because there's a lot of people that are in the market now and are using margin, and they're a contrary opinion. In other words, the number of people bullish versus bearish is extremely high, and with the fact that all these patterns are coming together, we'll see if that has anything to do with it. And of course, we have the Bradley model that's saying that we have something, really big happening cyclically, at the end of May, early in June. We'll find out if that's going to be the final thing that's going to happen. I'm going to try to have Arch Crawford on my show next week, either on Monday or Wednesday, to give us an idea of where we stand, and then also in a week or so, I'm going to be having Mark Douglas on, because Mark is finishing his latest book, and it's going to be very, very good, and we'll talk about that a little bit on the show. So it will be fun to have those folks on. But all I end the show here, because we're into the last part of this, is that we are very, very close to, I think, something very, very dramatic happening in the market. Whether it's going to be as dramatic as what happened in the Nikkei this week, with the market down, almost 6% last night, I don't know. But I just know that when it happens, it's going to rattle the cages of all the little monkeys washing the coconuts all through Wall Street and London and Germany and all the other places. So it's going to be pretty significant. What the event will be, I'm not sure. And it might not even happen. I don't know. I'm just saying that it's all set up to do it, with all the patterns and all the bullishness that's out there, and the fact that the cycles are coming in supposedly at this time. We will find out if that's going to work the way, and it won't be very long. We won't have to wait a month to see this. This is going to happen shortly. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.